Gold is a representative dollar hedging tool. Gold is considered a great store of value around the world. Even though it does not generate cash flows, many people think gold is a great hedge against inflation. Unlike coins or paper money, gold has maintained its stability over centuries. When interest rates go down or the dollar weakens, the price of gold rises. This is because investment demand increases to protect against inflation. Conversely, when interest rates rise and the dollar strengthens, demand for gold, which does not generate interest income, decreases. Currently, the global gold price and the U.S. 10-year maturity Treasury bonds interest rates are rising together. The reverse correlation that has been applied to the market for a long time is being violated. As cash value rises, gold prices begin to fall away from the market principle. Analysis suggests that this is because central banks around the world, including China, have begun aggressively purchasing gold. The inverse correlation between gold and the cash in the U.S. market began to go astray this year. Government bond interest rates, which represent the price of cash, have continued to rise. Cash value has risen. Since last year, the price of gold, known as a hedging tool, has also been rising by about 18% over the past year. As of September 21st, the interest rates on U.S. 10-year maturity inflation-linked government bonds was 2.11% per annum. It reached its highest level since the 2009 financial crisis. The real interest rate is the nominal interest rate minus inflation. Even if inflation is removed, the price of gold and the value of cash rose together. The spot price of gold recorded $1,923.72 per troy ounce, down 0.09% from the previous day. It rose 18.2% compared to the year ago. On the New York Mercantile Exchange, the December gold futures price closed at $1,945.60 per troy ounce on the 22nd, reaching a higher level than before the COVID-19 outbreak. The trading industry has used this formula to evaluate the value of gold. It mainly measures the appropriate value of gold by tracking trend in real interest rates. This is because it was better than other assets. Some point out that the formula of the inverse relationship between gold and government bond interest rates has been broken this year, creating a bubble in the price of gold. Considering this year's interest rates level, the price of gold should be about 50% lower than it is now. Emerging countries continue to develop. As a result, consumer demand for gold in emerging wealthy countries has increased. China and India are the world's largest consumers of gold bullion. The middle classes in these countries are growing rapidly. They are countries where gold products are part of their culture. For example, India is one of the world's largest gold consumers. In India, it is fashionable to own gold jewelry. India's total household gold holdings exceed those of the world's 5 largest central banks. Moreover, in Asia, it is common to gift gold jewelry or decorate with gold. There is also an analysis that the price of gold soared as the People's Bank of China, China's central bank, which is waging a currency war with the United States, purchased large quantities of gold. They have been purchasing gold for a year to reduce their dependence on the dollar and increase the influence of the yuan. In August, the People's Bank of China's gold reserves are estimated to have increased by 930,000 troy ounces. This amounts to approximately 29 tons. As a result, the total amount of gold held by the People's Bank of China approached 2,165 tons. This is an increase of approximately 271 tons compared to November last year. On the other hand, China's total foreign currency reserves amounted to $3.161 trillion as of the end of August, down $44.2 billion from the previous month. China attempts to expand the yuan payment system, focusing on BRICS member countries such as Brazil, South Africa, Russia, and India. It is one way to attempt to reduce dependence on the US dollar. There are mixed views in the market regarding the price of gold. Some predicted that gold prices will peak and then fall. This is because total gold purchases continue to decline despite China's aggressive purchases. According to the World Gold Association, the official gold purchases by central banks in each country in the second quarter amounted to 103 tons after reaching the maximum 458 tons in the third quarter of last year. It has been decreasing for 3 consecutive quarters. On the other hand, there is also an analysis that the price of gold has drawn a new lower limit. It is predicted that the price will not fall below a certain level because the central bank of each country have aggressively purchased gold. It is predicted that if the US economic slowdown is combined with this, the demand for gold from asset management companies and individual investors will increase, causing the price of gold to skyrocket. The Federal Reserve's intention to continue high interest rates is clear. In addition, with the deadline of September 30th local time approaching, the U.S. Congress is unlikely to pass the budget for the 2021 fiscal year, raising concerns that a shutdown that will paralyze the function of the federal government starting October 1st will be inevitable. The shutdown itself is not a factor that directly impacts the New York stock market, but if the shutdown is prolonged, it could have a serious impact on the U.S. economy and lead to worsening corporate performance. If indicators that the U.S. economy continues to slow announced, the price of gold is expected to exceed the $2,100 per troy ounce level by early next year. As each country's financial situation deteriorates, gold may reemerge as a store of value.